So yes, Aaron has discussed, the yield curve in February of this year due to the U.S. Treasury yield curve going inverted. But seeing that the yield curve continues to be inverted and is currently at its lowest level since 1981, and also that Brett and I are studying, the yield curve in the level 3 CFA, I thought that I would go into what this means and explain how the yield curve has historically performed in relation to the business cycle. So, what is the yield curve? I'll go over this quickly because, again, Aaron did touch on this. So, the yield curve shows the relationship between bond yields and maturities. So, generally, shorter term yields tend to represent what investors believe will happen to central bank policies in the near future, whereas longer dated maturities represent investors' guess at where inflation, growth, and interest rates are headed over the medium to long term. And we call this the term premium. So, the reason the yield curve tends to be upward sloping is because long-term bond investors are being compensated with this term premium for the greater uncertainty of growth and inflation risk of holding a bond long-term. And I have taken the U.S. Treasury yield curve here from February of 2017 to show you what a normal upward sloping yield curve looks like. So as you can see here, the shorter the maturity of the bond, more on the left-hand side here, the lower the interest rate. And when we get all the way up to the 10 to 30 year bonds, they have yields at about 2.5% to just over 3%. However, in 2023, we have seen this normal sloping yield curve go inverted. And here is a nice visual representation from Kara McDaniel Economics on YouTube to show you how the yield curve has fluctuated since February of 2017.
This is thrilling.
I love it. But it's just a good
so can you
visual
describe
representation
to them what's happening?
Yeah, so this is a good point. For anyone who's listening, essentially we're watching the yield curve once we get through Ryan's laughing.
Sorry.
No, I love it. It's great. But yes, what we're seeing basically here is just each month, basically the yield curve shifting, where eventually we're seeing the shorter term rates increase to where they're at about 4.5%. And this is, I guess, as of February 10th of 2023. And the longer maturities are actually lower than the short-term maturities, and they're at about 4%. So the yield curve has gone inverted as bond investors are demanding a premium for short-term bonds, and that long-term investors are likely anticipating inflation and long-term rates to decline as the economy slows due to short-term rates being elevated. And just for a more up-to-date picture, as of Monday, August 14th, this is what the yield curve looks like. It is still inverted. And of course, like Ryan was saying in the intro, in the finance industry, the inverted yield curve is generally seen as an indicator of a coming recession over the next 6 months to a year. So I thought that it would be beneficial to look at how the yield curve generally acts in relation to the business cycle. So let's get your laughs before, but I made this beautiful drawing that essentially shows the business cycle. So as you can see here, we're going up to basically a peak, and then we go down into a trough. Again, I'm not an artist, but it is a good visual representation. So starting at the left from the peak, at the peak of a cycle, the yield curve tends to be flat or inverted because the economy is ripping. That's a classic Saskatchewan term, ripping. And inflation begins to become an issue, leading central banks to raise short-term rates, and long-term bond investors begin to anticipate for growth, inflation, and interest rates to decline. Now, moving to the right, as the economy begins to go into a contraction, central banks begin to decrease short-term rates as inflation subsides from the economy slowing. So the yield curve begins to steepen, essentially. Now, at the trough of the cycle, the yield curve becomes very steep because inflation is quite low and the central banks have interest rates very low to help stimulate the economy out of the downturn. And as we go back up the cycle into the recovery and upcycle, the yield curve tends to flatten as the economy again heats up or starts to rip and inflation increases and the central bank increases short-term interest rates. So that's just kind of a visual representation here. However, there has been a lot of debate on whether the yield curve is still a good predictor of the business cycle, as we have seen an inverted yield curve in unison with continued strong economic data. And even recently, several analysts have been debating that this time it is different, with Goldman Sachs indicating it's different because the term premium is well below its long-term average. Or in other words, investors are not being compensated for the risk of holding long-term bonds. So it takes fewer expected rate cuts to invert the curve. And they also argue that as inflation cools, it opens a possible path to the Federal Reserve easing up on interest rates without triggering a recession. And others argue that the yield curve is simply just being overly pessimistic, and these expectations are priced into the yield curve, especially those long-term rates. So, are we headed for a recession? Who's to say? An inverted yield curve has given false signals in the past, but regardless, as an investor, understanding how the yield curve has generally acted in relation to the business cycle is certainly a good piece of information to know, especially for asset allocation as you're looking between, bonds in your portfolio or, equities. So yeah, I will open it up to you guys. It was more of a an educational section, and just to put the yield curve in relation to the business cycle.
Yeah, for
Great
sure.
drawing.
And a lot of ripping, which
And
is
thanks
good
for
to hear
saying
about.
that I've got nice drawing. Yes.
Oh, it's very nice.
I was actually trying to look for an actual image that I could just pop up, to show
Sometimes
something
you got to
similar.
create it yourself, right? You got
So
to
I
go
had to
that.
create it
Well done.
myself.
I mean,
Yes.
I do think we came from such an extraordinary period, historic low rates, then like a historic rate of increase in inflation.
Yep.
It's such a strange period that there may be some false signals out there. But I mean, the inversion of the yield curve, I think I'd looked up since 1978, the yield curve has inverted 6 times, not counting the current inversion period, and this has preceded a recession each time.
Yep.
So, I mean, it has been a pretty reliable predictor. I do think that, is it different this time is something you hear a lot. And a lot of the time it doesn't end up being different. People wish it to be different. So they're making up arguments to frame around the way they'd like to see the world go. At some point, you have higher rates, people are feeling a squeeze. A recession does feel like, it could be in the cards at some point. So, I mean, that's the way I would see it. I think people have to stop spending. I think the economy has to cool down. This doesn't mean there isn't some tremendous opportunities in the market. There will be, but I think it would be a healthy thing. I think we haven't had enough, enough of a pullback in some areas, and focus on cash flow and focus on your own balance sheet in the home. So people could do that, and it may lead to a period of less economic growth, but that's okay. It's not the end of the world if that happens. So yeah, and we'll see if this predicts a recession correctly this time.
Yeah. A quick related tangent is Bill Ackman. He actually made headlines for shorting a 30-year bond last week. So effectively, what he is saying, because all fixed income really is based on the yield curve. You need to understand it. You need to understand the movement for fixed income investing, especially once you're getting into these more elaborate trades and the positions. So what he is saying is the 30-year bond, it will decrease in price. So on the yield curve, that means an increased yield price. And that's how it would uninvert, is it would be the 30-year bonds, and that'd be the 20 and the 10, which are even more. The 10 years normally the more common benchmark, would start to rise in yield, which would uninvert the yield curve. So you'd have effectively a static, maybe slightly lower your 1 to 2 years. And then the 30-year it goes back up, and that's how he would make his money. So he is shorting bonds, but that means he's effectively saying he believes yields are going to rise. And the background behind this is he says inflation is higher for longer, and that's the thesis behind that sort of trade. And I've seen a couple other similar trading theses around. If you've seen any of those online, that's the reason behind it.
Yeah, and that even goes into relation with just what I was saying about Goldman Sachs. So Goldman Sachs, again, was indicating that the term premium on the long-term maturities is smaller than usual. So if all of a sudden that term premium is going to increase and go back to, what we've historically seen, rates should increase, which would also, give them some profits. Again, if this is the way that it plays out. But yeah, that's a good point, Brett. That Bill Ackman, I did recently see that in the news, and just a good job to explaining, what being short bonds actually means. You're expecting rates to increase.